Hedge funds. They suck. Seriously. Unless you have over $500 million, then starting and operating a hedge fund really doesn't make sense. Now, I have a lot of respect for Steven from CoffeeZilla. However, I watched a recent video of his where he had, I think, Patrick Boyle on his show. And I feel that Steven gave too much credibility to a hedge fund manager. Because the fact is that as a hedge fund manager, you are not incentivized to generate alpha returns relative to the market, which is one of the reasons why the majority of hedge funds do not even beat the S&P 500. Then if you factor in where a regular retail investor can purchase the S&P 500 and then sell covered calls against it, I would estimate that you would generate greater returns than 95% of the hedge funds out there. So for YouTubers to think that a hedge fund manager is the end-all be-all, it's not like that. And coming from someone like myself, who graduated from an Ivy League university, who has a lot of friends at hedge funds, who worked at Morgan Stanley, CIBC World Markets, and Pesky Prunier, I spoke to private equity firms and hedge funds multiple times a week. I can tell you that unless you have over $500 million, it doesn't even make sense for you to own an official hedge fund because the fees and the regulations are so crushing that, again, it is not even worth your time to operate a hedge fund. Many hedge fund managers are asset gatherers. Their goal is to seek and increase their assets under management as much as possible so that they can collect that 2% a year that they charge their clients. The typical structure of a hedge fund is that they charge 2% a year to all of their assets under management, plus they get 20% of the returns in excess of the S&P 500. As a result, the majority of the fees are coming from the asset management component, where essentially the hedge fund is collecting 2% for doing no work. If the hedge fund does not make money and they perform worse than the S&P 500, then they still collect the 2% management fee. Additionally, hedge funds are not incentivized to take risks because the worst thing that could possibly happen to a hedge fund is redemptions, meaning people taking their money out. So it is not in the hedge fund's best interest to try to hit a home run, because if they strike out and then a lot of their clients redeem their money and pull out of the fund, then that hedge fund might actually have to close down. So as a result, from my experience, it is not worthwhile for anyone to run a hedge fund unless they have over $500 million in assets under management. The fees, the regulatory filings, the regulations are just too cumbersome and they're just too overwhelming. And for many people who are putting hedge fund managers on a pedestal because they believe that hedge fund managers know more than the typical retail investor, I can tell you that that's a really bad way of looking at things. Do not think that you're inferior to anyone. Do not believe that just because someone is a hedge fund manager and they have a fancy title, that they know more about the stock market than you do. Because in reality, the stock market is not necessarily something that rewards education. Prices in the stock market are relatively accurate, meaning it is reasonable to assume that prices of a stock reflect all of the available public information as well as the market factors that are influencing the price. As a result, it would be foolish for a retail investor to put a hedge fund manager on a pedestal and assume that they know more about what influences the price of a specific security than others. I remember in the past, when I was in my teens and early 20s, I used to think that a stock was undervalued. And what I would do is I would just buy it and then I would hold it. And oftentimes I would have to wait 3 or 4 years for the market to recognize that I was right. And sometimes the price of that underlying stock never went up. Sometimes I lost money. So for you to think that based upon some type of fundamental analysis that the market is mispricing a security and that you know more than the market in aggregate, in my opinion, is pretty foolish. The best way to invest and trade in the market is to assume that prices are relatively reasonable and the market does a reasonable job of reflecting all of the available inputs in the current market price. And as a result, when you think that way, then you come to the realization that nobody knows more than you do and nobody knows less than you do. Instead, the best thing to focus on is your trading and investing strategy, which is why I recommend selling options, because when you sell options, each trade has a positive expected outcome. Or if you don't want to learn options trading, then you can simply buy the S&P 500 or buy Tesla, Amazon, Facebook, or a large cap underlying that has a very liquid market, and then just simply sell covered calls against that security. David Jaffe with BestStockStrategy.com. Let me know your thoughts on hedge fund managers and whether you believe that they deserve to be placed on a pedestal. If you have any questions, leave a comment below, and I appreciate your attention.